Hello and welcome to our buyer seminar where we are going to talk about the steps of home ownership and what it's going to take to get you into a home. So let's get started here. So this is brought to you by OK Homes and Lifestyle Group with Coldwell Banker Select. That's Dana and I. We run the OK Homes and Lifestyle team. Brian, he is a mortgage lender with BOK. And then Chelsea, she is our admin. She keeps Dana and I in check and making sure that we look the best. So she keeps us organized. So if you have not joined our Facebook group, please, please, please join our Facebook group. It has lots of freebies in there for you. We will also have the replays in there for you for probably about 24, 48 hours in there. So you can go back and rewatch them if you want. Though there's lots of free resources in there. There's a buyer's guide. There's a moving guide. There's a book that Dana and I co-authored, and that is in there as well. So please go and use that. There's lots of free resources in there for you. This is our team. So we have Dana and I, like I said, and then we also have 3 other people that are on our team, the Allen Home team, Rebecca Fink, and then Jerry Sherwood. They are all a part of our team. So if for some reason, you'll be working with one of us. So if you choose to work with us, so that's our team. Here's the agenda, what we're going to be covering today and tomorrow. We're going to make sure and be very cognizant of your time. We only plan to be on here an hour and a half max. So, we don't want to take a lot of your evening. So day 1, we're going to cover the different types of loans with Brian, also some down payment assistance programs, and then also the loan process. Day 2, we're going to cover some home buyer basics along with some credit is key with Lance. He is a credit guru. He helps you build your credit. If there's any bankruptcies or anything like that, he can help you get that ball rolling and get your credit where it needs to be. So then Brian can help you with a loan. And then we're also going to cover the criteria of home shopping.
The fun part.
Yes, the fun part. Absolutely. Okay, house rules. Oh, I'm so sorry. My Santa's here. I'm so sorry. My phone was not. Did you guys hear that? I think my
Ho, ho,
family.
ho.
Yeah.
All right, Chelsea, you want to go over the house rules for
Yes,
us?
please.
All right, so we have one simple house rules. If you do have questions, feel free to raise your hand on our Zoom reaction, or you could also post it on the chat. If you are watching this through a recording, feel free to also leave your questions or comment, and we'll make sure that one of us will answer your question. Back to you, Sarah.
All right. So this actually Dana's going to take over from here. She doesn't have control of the screen, so she didn't know what was next. So.
All right. So I think one of the biggest challenges for all of us in our life is just overcoming negative beliefs. And 9 times out of 10, the things that we're worried about or stressed about aren't even necessarily true. We've just worked them up in our heads to be so much worse than they are. So maybe you've always felt like owning a home is just, it's out of your reach. Like you're not going to be able to do it. Or maybe no one in your family has ever owned a home. So nobody in your family really knows how to go about or how to help you with that. Or maybe you don't know, maybe you've only rented properties and you're not sure if what it takes to maintain a house, the money involved in taking care of your home after you purchase it. Or maybe you just are unsure about how much money it actually takes to buy a home. And then, of course, the big one, I just don't know where to start, right? And that's what we're going to help you with today. We're going to show you the steps. We're going to help you with finances. We're going to help you with all of the things that you need to know to overcome these beliefs and to be a confident home buyer. The big one, I'll never have enough money. We're gonna go over that more in depth tomorrow, but I'm just here to tell you, if you want something bad enough, you're gonna make it happen. Have you ever saved up for, a special night out, or maybe that car you've always wanted, or, we all have different goals and financial goals in our life. And I'm telling you, if you can do that, you can do this. It just takes a little bit longer. All right, some of the benefits of owning. First of all, you get to pick where you live. I think that's a huge one. You get to finally paint the walls. I think that's a big one. Or maybe you're a big renovator and DIYer and you want to flip something, that's also another opportunity. Um, let's see, what else? You can actually create you can involve yourself in the community and create friends through that. And like I have some lifelong friends that I made just joining the Moms Club. Like that's actually how Sarah and I met initially, was
Yeah.
we joined a group in our community and that's how we got connected. It's just also just a nice place to land, a place to host parties, all the awesome things that come with owning a home. And one nice thing actually about knowing what your loan is and what you can afford is your house, you're going to know what your house payment is month after month after month. You're not going to have some massive surprise like rent hike because your landlord decides they need to make a little more extra money this month. So that's a huge benefit, just knowing your monthly payment.
Yeah.
And now I'm going to turn it over to Brian. He is our lending guru and someone that we go to, and we've been working together since 2019, I believe. Isn't that correct, Brian? But gosh, Brian has 20 plus years of experience and, he does business like we do. He's really big on customer service and that's why we enjoy partnering with him. So Brian, I'm going to let you take it away.
Thank you. Yeah, so this is actually, Dana, January will be my 22nd year in the business. I know I don't look like I'm that old. I did it right out of college, not knowing any different. Like anybody that becomes a mortgage banker, you just kind of fall into it and fall in love with it fairly quickly. So there's a lot of knowledge that I can bring to the table. When you become, interested in buying a home and start to think about getting pre-qualified, it is overwhelming, and there's a lot of lenders online. There's a lot of lenders locally. But my biggest tip would be to make sure that you find someone that's got some real experience that can lead you the right way. It's not always about who's cheapest, because I'll tell you, if you ask somebody 1 year after they purchase their house, they probably can't tell you what their interest rate is, but they can tell you how their experience with. And you guys know that's worth its weight in gold. And so from a customer service perspective, my goal is to deliver a 5-star referral experience every single time. And I mean that not just for you, the home buyer, but I mean that for the agent, Sarah or Dan, whoever refers that client to me. I want to make sure that I'm representing them very well and you at the same time. So there's a lot of knowledge that goes into making sure that we accomplish that goal. So I'm very confident I can meet that need in that way. And hopefully after we've gone through today's topics, you'll believe that too. I was listening to you talk for a minute, Dana, about some of the things that prevent people from getting into this process. And there's some interesting stats that I've heard over the last 6 months that I think it's worth noting before we dig into, the nitty-gritty of the loan programs. One of the things is rent and the pressure on rent prices. In Oklahoma, this is a crazy stat, but for every one new house built, you have 300 buyers wanting to buy a home. And so it's not pacing. And what does that do? That creates a larger gap of people that are even able to buy, because that pushes pressure on housing to buy a home, but also pushes pressure on renting. Those people are going to end up in the renter bucket, and that rental is going to keep going up. And over the next few years, you're going to see that get a lot more pressure on renting. And so if you're sitting in your chair watching this and you're like, man, I'm going to wait for interest rates to go up before I do anything, I'm going to caution you that's a very wrong idea. And here's why. If you would have bought a house in January of 2020, when the rate was probably in the late high fours or low fives, you would have bought let's say a $200,000 house. That same house today is almost $300,000. So if you're waiting for rates to go up and you got mistracked for 5 years, you just gave up $100,000 in equity. That's real money. And if we want to put this on a 2-year basis, because that's what we think is actually going to be when the rates come down. If you have a house that is $200,000 today, and this is real numbers, we're looking at seeing in Tulsa County a 10 to 15% market value increase year over year. you're going to pay another $30,000 for that house in 2 years than you would now. And when you look at what the rate is then, let's say it's 4.5% versus today's 6.5%, the payment's still going to be more expensive, even though the rate's lower. So if you're thinking about buying a house but you're waiting for rates, that's a very bad idea for that reason.
Well, and
Yeah.
on top of that, Brian, not to mention every other buyer and his brother and cousin and uncle are going to jump into that market too. And then you're going to have a lot of competition and you're not going to be able to negotiate the terms that you really need or want, let's just say want,
Right.
like you can right now because there's not as many people buying. There just isn't.
That's a great point, Dana. Whenever the rates drop to the point where the media and kind of everyone jumps on board, now's the time to buy and refinance. All of these first-time home buyers that were wanting to come to market are pushed out almost as fast as they walked into it. So don't let interest rate be a deterrent. We can all buy the house now. We can refinance it later for you when the rates do come down. Just don't let the rates be a point of pain on not buying a house. We can work through that.
And I
Also,
will
if you
tell you, I've done that with every house. We've refinanced every house we bought. So it's
yeah, it's just part of
worthwhile.
the game. It's part of
Yeah.
the game. And the other thing I was going to say, if you think that you know this is too hard of a process and you can never do it, I'm going to lean on this statement. Nothing ever worth doing is rarely easy. So yes, it can be difficult, but when you get to the end of it, it's so worth it. And you'll find that whenever you buy the house, you get in there, you've been there for a few years, and you're seeing your market value go up, and you can sell that house and buy that beautiful home that you wanted for you and your family, and you grow into it. So this is just a starting point on the journey to the property ladder. If you're a first-time home buyer, if you haven't bought in a long time and you've kind of forgot what it feels like, this is going to be a refresher course for you. Hopefully it helps you come back to the market. But in any of those things that we've just talked about, if you're not sure, call Dana, call Sarah, call me. We can help guide you just on those first few pain points that you might be feeling. But once we get through the rest of this information, I hope that I'm able to walk you through this in a way that's going to make you feel better about this. This isn't a dentist appointment, it can feel that way. It's really just, it's a way for you to discover what you need to do and then just go do it if you can't do it right now. So I don't know if I have access to move this thing around.
You
I
should,
do?
yes.
Okay.
Information is power, people. So that's why
All
we're
right.
information is power. But yeah, you should have control.
So first, we're going to walk through just the big 5 loan programs. There's a lot of loan programs out there, but 95% of people watching this video are going to fall into 5 basic categories. Is it going to be conventional, FHA, VA, USDA, or rural development? Or I'm sorry, conventional, FHA, VA, Section 184, or rural development. Those are the big 5. Outside of that, there's a whole other world that really won't apply to this conversation, but those are the big 5 loans that you're going to want to know about, and those are the ones that we're going to go over today. And I'm going to click this and see if it works. There we go. Here they are. Conventional, FHA 184. I wish I could see the future slides. USDA and VA. These are the ones that we're going to talk about today. Again, if you have a question while we're going through these, sometimes I can talk fast. Just tell me to slow down or shut up and ask the question, and we'll walk through it. And if you're watching this as a recording, the previous slide had my contact information. Just call me or email me. Okay, so for conventional loans, this is the loan that the majority of buyers look into, I would say, and FHA. But a conventional loan is simply a loan that's offered by Fannie Mae or Freddie Mac. That is a conventional loan. That's a securitized loan. And so it's a mortgage that is not insured or guaranteed by the federal government, but there are guidelines. There are some things that the government will oversee on this loan, but it's basically a private loan. These mortgages are traded on the open market in a form of what's called a mortgage-backed security. That's what allows us to get you low down payment access. That and mortgage insurance. We'll go on that in a minute. But basically, it's a Fannie Mae or Freddie Mac loan. That's what a conventional loan is. And then the credit score requirements. It's a hard 620. There's nobody out there that can do lower than 620 on a conventional loan because that's the program requirement. That's what they require. And that's what we have to write it at that or higher. I will say that if you're below a 680 and you don't have much money, And there's just some other factors that might be negative about your profile. It's really hard to get a conventional loan approval. In those circumstances, we would want to move to FHA. But if you have a large amount of money in your banking, but you have maybe a lower credit score than a conventional, it might be something that you'd want to consider. I will tell you that the rates are better on a conventional loan with higher credit scores. Since it is a semi-private loan, there's real risk involved. So there's going to be higher interest rates for lower credit scores. That's just the way the world works. More risk requires more reward in that manner. Down payments, it's as little as 3%. If you're a first-time home buyer, if you want to avoid the monthly mortgage insurance, that's 20% down. The reason why we have mortgage insurance, just to touch on that, is the only way that you're able to do a down payment that's less than 20% on this particular loan is because there's mortgage insurance. Mortgage insurance ensures a 20% loss that the lender would be taking. So the lender has 80% in, and that 20% is what they're insuring in case the mortgage defaulted. They're covering the full 100% with the mortgage insurance. That's why it's required. There's lots of different types of mortgage insurance. Most people in their first time just do the monthly, but there is lender paid insurance where you take a higher interest rate and the lender pays the mortgage insurance for you and you don't have it. There's a one-time buyout premium that you can look into to buy out your mortgage insurance. The bigger the down payment, the cheaper that buyout premium is. And they're split, where the buyer pays part of it and the lender pays the other half to make it cheaper. So there's a lot of different options involved in mortgage insurance that you can look into. But the basic cookie cutter mortgage insurance that everyone talks about is just the standard monthly mortgage insurance. But we can talk about the other ones too if you would like whenever we do speak.
And just to be clear, that insurance is not for the buyer. That insurance is for the lender.
Correct.
Company
that
that
allows
backing
yes
loan.
yes that allows us to give you 97% of the value of the home in a loan instead of just 80%.
Right.
The lender has 80% and then mortgage insurance covers the rest of that. That's how we can do less than 20% down. The standard debt to income ratio limit for a conventional loan, and this is somewhat based on your credit score, is 49.99. The standard, if you're getting a manual underwriting approval, not getting an automated approval, is much lower. But it is based in credit and your overall risk profile. So we have to run that through our automated underwriting system, find out if you can get up to 49.99, but that is the limit. And the way that they determine debt ratio, just so that it's not so confusing on what that actually means, there's two different types of debt ratios. There's the housing ratio, also known as the front end ratio, and then there's the total debt ratio, which is the back end ratio. The front end ratio or housing ratio is purely just your monthly estimated mortgage payment, the total PITI, which is principal, interest, taxes, home insurance, and mortgage insurance. That total estimated payment divided by your gross, not net, your gross monthly income. That's what figures out that ratio. And then the total debt ratio is all the payments on your credit report plus your estimated mortgage payment divided by your monthly gross income. That's how we get the total debt ratio. So if we added up all your creditors on all the payments on your credit report plus the estimated mortgage payment, if it's over 50%, we got to figure out how to get you below 50. That means either we look at some debt for you to take care of, or we just decrease your sales price until we get you inside a lendable range. That's how we do that. Let me go to the next slide.
And when you talk about private mortgage insurance, it's not like thousands of dollars. It's like $100+ a month extra on your payment.
Yeah, and we'll get into some of these. I don't know why this is not working for me. With mortgage insurance, if you're doing like a first-time home buyer Fannie or Freddie loan, they have discounted mortgage insurance for those customers. But it's highly based on your credit score on conventional loans, and same way on the mortgage insurance. If you have a 640 credit score, your mortgage insurance premium is going to be a lot higher than if you have a 780 credit score. And that's why we have to look at those and go, okay, hey, maybe you're going to be better off in an FHA loan when we look at the overall payment because of that. And we'll look at those side by side to see which one's actually better for the customer so that they're taking full advantage of that. I already went through this one. Oh, no, I'm having problems here. Here we go. All right, the conventional loan limits vary by region, and they're set by the FHFA. The new loan limits just came out this month for 2025, and now in Oklahoma, you can buy up to, or you can loan up to 806,500. That's the limit of the loan amount for a conventional loan. Most people on this call probably won't need to think about that figure. That's well higher than probably what they're considering. But if you're in that range, that's the loan amount, not the sales price. So if we want to look at what the minimum sales price would be, I'll get my calculator here. You would take the, get my calculator. You would take the 806,500, divide that by 0.97. It'd be about 831,000 would be the minimum purchase price to get in at 3% down. That's probably not going to work for most people because they're going to be over the housing limit. So if we did 5%, you're looking at, just for everybody who's watching in case they're in that range, would be 848,900 would be the sales price max in order to get minimum down payment of 5%. You can do $1 million and finance 806,500, but you pay that difference in the down payment. On high cost lending, it's $1.2 million and some change. Again, probably most people aren't going to be on this call. They're looking at that price range. Proof of income. When we're looking at getting you qualified, there's three basic things that we're looking at up front. We look at your credit. We look at your, not just your credit score. We really dig into your credit report, but we look at your credit, your income, and your ability to close from a monetary standpoint. So we're looking at your funds for closing. Those are the three areas that we have to talk about because you have to have all three. You can't have one without the other. You can't have great credit, no income, and lots of money. That's not going to work. You can't have great credit, lots of income, and no money. Like you have to have all three of those. So if you have if you have credit and income but no money, then we have to look at ways of covering that gap. And there's down payment assistance we'll talk about later. And maybe seller assistance we can go into, and there's some other things to help that, but we got to have all three. So those are the things that we're looking at when we're looking at qualifying you. Specifically for income, if you're a W-2 employee, hourly or salary, we're going to look at your pay stubs. If it's determined that you're an hourly employee, but your hours vary week to week, that's considered a variable hourly employment. We have to dig farther into that to see what your actual average is on hours worked per week. For medical professionals like nurses, they have wild pay. That's shift differential, all different kinds of pay that we have to do averages on that. So there's not a cookie cutter. So when you're speaking with your loan officer and they're talking to you about how to get your income verified, it's not that they don't believe you. It's that they're trying to make sure that they have your income correct, because if they get that part wrong, everything else is going to be wrong past that. So especially for those buyers that are on that income cusp of the limit, like they're pushing the very limit of their approvability for their debt ratio. If we don't have that income correct, we breathe on that wrong, it could spell disaster. So your loan officer, no matter who it is, should be looking at that in depth. And we do things like getting verifications of employments from your employer if we can't ascertain from your pay stub where that's at. But we will dig into your income pretty deeply to make sure we have that right. If you're salaried, that's pretty easy. No big deal with that. We base that on what your salary is. And then if you're self-employed, we'll have to get tax returns for that. If you're in business on a conventional loan, since we're talking about conventional loans, if you've owned your business for 5 years or longer, then we'll maybe have to get the most recent tax year. If you've been in business for less than 5 years, we have to get most likely the last 2 tax years. And they're going to look at that income trend, not just, okay, here's what they made this year, here's what they made this year. We're going to look what the trend looks like. If the trend is going up, that's great. If it's going down by more than a certain percentage, that could be a problem. But we have to look at that, and we will look at that pretty deeply to make, especially for self-employed buyers, to make sure that we've set you up properly to go be successful in your home search. We just never want you to get in a position where you get qualified and then you find the house of your dreams and it blows up in underwriting because we didn't properly verify your income. So you want to make sure when you're speaking with your lender that they really dig into your income, because that's a very important piece of this. When you go into a home buying process, stop me if I'm going to bump into other things later, but you're going to start spending money. You're going to have to write a check to the seller with your offer. You're going to have inspections. You're going to have the appraisal. So we don't want you to start spending money frivolously. We want to make sure that you're covered there. So give us some grace when we're going through this qualification process with you. We're really just trying to protect you. Okay. It's not that we don't trust you. Okay. We'll go through your bank statements too to make sure you have the money for that, and we'll talk about the money side later as far as down payment stuff goes. Property requirements. Here's a big misconception that a conventional loan will turn a blind eye to property requirements. It will not. They're not that far off from government purchases as far as appraisal goes. So the property is going to have to be in good to great condition. When they do the appraisal, they'll actually assign a grade on a conventional loan. There's a grade that gets assigned. It's between C1 and C6. C1 is new construction. C2 is almost new construction, probably less than 5 years old. C3 is the condition is in average or above average. C4, there might be some problems. C5, there's some major problems. It probably needs to be bulldozed. If it gets a C4, it's going to be, they're going to probably tell us what needs to happen in order to make it a C3, and then we have to get those things fixed by the seller before we go to closing. But the appraisal will tell us that. And also, if we're in a rural area, they could say, hey, this value is maybe questionable, so we could have a desk review, but I won't go too far into all that. But yes, there could be property requirements even on a conventional loan. Just be mindful of that.
Well, and I will say that Sarah and I and our team, we know what to look for. We know if a property is going to meet the criteria or not, for pretty much all the loans. So we'll make sure that, and listen, any agent that you work with should know that as well. Like that's a given, truly, if it's not
Right.
us.
Right. And if you have, if you're working with a newer agent and they're not sure, they can always contact me and I can have them send me some pictures or I can look online at the pictures online. Usually I can tell from the online pictures how this is going to go, so we'll figure it out. Don't be discouraged by that. But if you have a newer agent, they may not know all the things to know yet. That doesn't mean anything that doesn't mean they're not a good agent. It just means that they may need to have some training there. So anyways, I don't know why this keeps going the wrong direction. Go that way. And we talked about PMI already. Let's talk about total settlement. When we're looking at your funds for closing, remember, let's go back. The three things we're looking at. We're looking at credit, income, and money for closing. So money for closing would be your total settlement. We're going to look at your down payment, your closing costs, and the prepaids and escrows. When you add all three of those things up, that's your total settlement. So for down payment, that depends on the product. If we're talking about a conventional loan, it could be as little as 3% or as much as you want it to be. But the standard is 3% if you're first time or 5% if you're a repeat or more. So one of those two. Let's just assume your first time we're going with 3% on $100,000 sales price. That would be, or let's do 200,000. That'd be 6,000 for your down payment. Closing costs are going to be, that bucket is your lender, the title company, the appraiser, any inspections that you want to do, filing fees with the county. That's what makes up the closing cost bucket. And then the final bucket, which is prepaids and escrows, is going to be tax and insurance collection, and then days of interest from the day of closing through the end of the month. On insurance collection, they're going to collect 15 months. That's 12 months to put the policy in force at closing and 3 months for your escrow cushion. And then with taxes, it depends on the part of the year. So let's say you closed in January, they're probably going to collect 4 months of taxes for that. If you're closing in June, probably more like 8 months of taxes for that. And the reason why is how the months count down. So if you closed in January, your first payment is March. Taxes are due in December. So the best you're going to get out of that is what, 9 months of tax collection in your mortgage payment. And you have 3 months that are outstanding plus 1 month cushion. So that's where we get to that 15. So I'm sorry, 2 months of the 1 month cushion. So that's how we get to that 15 month mark on home insurance. With taxes, I might have just confused myself there, but with taxes, they're going to count it down. So if usually like in January, you're gonna probably have 4 months, but it is based on the month that you close in the year and how many months are left. So when you add that up, that could be as much as, $2,500 to $3,000 in the prepaids and escrows. Closing costs on average are around 4,500, then your down payment. So when you add all that up, it can get costly. It can get expensive fast, and that's where having the right team behind you to help you navigate that cost is extremely important. And I'll go back again to the down payment. We can get the down payment covered for you. So if it's about, I don't have the money, don't let that be a distractor, because we can probably get that covered by the state. And then the closing costs and escrows, we can probably get covered by the seller, right? There's ways to get that done. We can roll that into the sales price. Dana and Sarah can help you with that, but there's ways to get the seller to cover that for you. So if the state's covering all your down payment and the seller's covering your closing costs, then there's very little for you to bring to the table outside of that. So we can help you navigate that. But this is the piece of this that no one ever thinks about. When I get the phone call to pre-qualify somebody, normally they're just, let's go buy a house, but then they haven't thought about how much it's actually going to cost them to get into it. Because again, you can have good credit or decent credit or even par credit, and you can have great income, but if you don't have this piece of it, how are we going to get through closing if you can't afford what's there? So we have to talk about this part of it, and we will go over that with you whenever you do qualify, to make sure you understand what you're actually getting into financially from a monthly payment perspective, and also what it's going to take to go to the closing table. But don't let
truth,
go ahead.
right? You can have this conversation now and then work on saving that money for 6 to 12 months and then come back to the table again. Interest rates might go up a little bit, they might come down a little bit, but overall, the amount of money you're going to need, if you know the range that you're trying to buy, is going to stay pretty constant, wouldn't you say?
Yeah. So with closing costs, those are all flat fees. Those aren't going to change a whole lot between 175 to 250, right? They're just not, or 300. They're all flat fee. There's only a couple of fees inside that closing cost bucket that are driven by sales price and loan amount. The rest are very flat. And then the prepaids and escrows, that's very property specific. Insurance and taxes are going to differ between property to property, and it's going to differ based on your insurance risk as an individual too. So those are hard to really guess up front. Me saying on the prepaids and escrows 2,500 to 3,000, that's just kind of where I see it land more often than not in this sales price range. Now, if you're buying a house that's 500,000 in South Tulsa, that prepaids and escrows bucket is going to be the most expensive piece of the pie because of how expensive taxes and insurance are going to be. So the one thing also I want to point out here, as a first-time home buyer, when you're looking at these costs, you need to understand that the lender is not charging you all this stuff. We are one small piece of this big puzzle. And from most first-time home buyers' perspective, they think we're the one charging them all this money. We're not. We do have our fee. We're not going to do this for free, right? There is an origination fee, and you're going to see that be somewhere between probably $500 and $1,500 on average in any market. That's the bulk of what we charge. All the rest of these costs involved in your transaction belong to somebody else. Just wanted to throw that out there. We take the heat on that a lot, and we're more of cheaper part of the process.
Well, it's because you're required to account for all that within the.
Yes.
So that's why they think you're in charge, because you guys have to make those numbers work.
Right. So we will put together your cost worksheet and get that to you. That's why most people think that we're in charge of the fees, and we're just in charge of reporting them. Looks like Sarah's doing what I was doing. Was that our last conventional slide?
Yes, it was. Yeah, sorry. I was
Okay.
trying to hit the space bar to talk, and I think it made the slides all go really fast. And I was like, oh, shoot. So I was putting them
That's
back
funny.
for you.
So FHA is what most people think is the first-time homebuyer program. Big misnomer. You don't have to be a first-time homebuyer to use this loan. You can use it as a second-time or third-time homebuyer if you need to. You just can't have more than one FHA loan open at any given time unless there's a couple factors. One is you had a death in the family. Another one is divorce. If the other spouse got the house, and you can go buy your own with the FHA loan, even though you may have an FHA loan jointly with your ex-spouse. So there's some ways to have more than one FHA loan, but it's clearly defined, and there's just a few reasons why that would be the case. But These are government-backed loans. And so the interest rates in an FHA loan are cheaper than conventional if you have lower credit scores, because it's government subsidized and there's not the same kind of risk involved in writing this loan that there would be on a conventional loan. That's why they're cheaper if you have lower credit scores. You can hit the next one, Sarah. Or do I have still access to it? Okay, let's talk about credit scores. FHA's minimum credit score is 500. That doesn't mean the loan company that you talk to is going to want to do a loan that low. Most lending institutions will decide what credit range they want to lend in, and that's their prerogative. They're writing the loan. They just can't go outside of what FHA requires, but they can definitely tighten it up for their own lending institutional risk profile strategies, right? With 500 to 579, it's a 10% down payment. And if you're a first-time home buyer, you probably don't have that kind of money. This is a very hard loan to get into if you're between 500 and 579. It's like going to the casino and pulling that thing, and all the little numbers have to line up for you to get into it. You can't have any, I don't believe you can have any collection accounts hit your credit in the last 12 months, no late payments on anything that's outstanding, and then you've got to have 10% down. So if you're in that credit score range, there's probably a pretty good chance that you've had some things go wrong in the last 12 months. That's just kind of what happens in that range. But there is always the example where that's not the case. But 10% down is a requirement if you're below 580. If you're between 580 and 619, well, actually 580 and above really is going to be 3.5% once you get to 580. Now, when you're in between that 580 and 619 credit range, that is considered low for FHA, and there will definitely be a pricing or interest rate adjustment based on you being in that credit score range. So your interest rate will be a little higher in that range. Once you get over 620, though, whether you're a 620 or a 780, there's not a lot of difference in the interest rate that's offered to that 620 person than that person that's at a 780 or even 800 credit score. There's a little bit difference, but it's very minute. Okay, nothing to steer you away from the program like you would in a conventional loan, where there's a big difference between a 620 and a 700 or an 800 credit score. What else? The debt to income ratio limit for FHA is 56.99%. Again, that's going to be based on the overall risk profile. When we find out if you can go that high, we basically put you through our automated underwriting system, and it'll give us a yes or no, basically. That's oversimplifying it, but there is an automated underwriting system that reviews the entire application, analyzes the data, and assess the risk, and will allow or not allow you to go up that high. I will say if you're below 620, getting above a 50% mark is probably going to be pretty high. Or pretty low. I mean, if you're above 620, getting above 50% on your debt ratio is more likely. And another thing on here, the compensating factors. If you're a 620 credit score and you have money saved up, that does help offset the risk and can help you get approved. Or if you have low debt ratio, that can, I'm sorry, not low debt ratios, but stable income. So you've been at your job for a long time, that can help you get there too. Those are some of the things that it looks at. There we go. Loan limits. Right now it's 524, 225. And if you're in a high cost area, it's 1.2. I don't think anybody on this call is going to need to worry about being that high, but that's what they are if you're interested in knowing. Mortgage insurance. Here's the good part about FHA. There's good and bad with mortgage insurance for FHA. The good part is that it has nothing to do with your credit score. Everybody gets the same premium, whether you've got a 580 or a 800. There is a monthly upfront mortgage. There's an upfront mortgage insurance premium of 1.75%. And that is financed into the loan. You don't have to pay that out of pocket. You can if you want, but no one ever does. And then there's the monthly fee, and that's down payment driven. If you're just doing the normal 3.5% down, it's 0.055% of your loan amount divided by 12, and that's how they figure out what that is. But it's 0.55 is what it is. So on a $100,000 loan, you're looking at like $55 a month, maybe like that. And then the property standards on FHA, there's a couple of things with that. They're looking at the property from the perspective of, is what I'm looking at, is this particular issue what I'm looking at, unsafe? If it is, then they're probably going to list it as a requirement. And I'll give you a couple ones that I see all the time. Peeling paint is something I see all the time. And it's not just the house. So if there's detached garages or outbuildings on the property, those are going to be subject to FHA condition requirements. So if there's peeling paint on those buildings, it's going to have to be fixed too. What's another one I see? Railing. I see railing all the time. Like if you have a porch with 2 steps, more than two steps or more, you got to have a rail. Or I've seen like carpet where it's kind of rolled up, it's been pinched up, it's a tripping hazard. Those can get listed. If there's wires hanging out of the ceiling because there's a missing fan or light bulb, that can get called. If in the kitchen there's not GFCI, that can get called. So there are a few things that I see come up more often than not, but again, like I said earlier, it's not wildly different from conventional loan standards. I don't want you to feel like if you're watching this, getting FHA loans going to be hard to pass a property inspection. It's not at all. You just don't want to find a house that looks like it's been 30 years untouched and it just needs a lot of work. But your agent, in this case, the Owasso Homes Land team can help you out. Dana, Sarah, anybody else on the team can help you with that. Everybody's very well versed in that. And let me get the next one. I'm getting the hang of this, Sarah. Proof of income. This follows conventional Fannie Mae and Freddie Mac pretty closely. There's one big difference though. On self-employment, it doesn't matter if you've been in business for 1 year or 20 years. You're going to have to provide the last 2 years of tax returns. And I'll dig this a little deeper. If you file a partnership or an S Corp, or whatever the case is, if you file a separate tax return, they're going to want personal returns for the last 2 years and the business returns if you file separate business returns. So don't feel like they're trying to analyze your blood type. It's what we're required to ask for. And I'll say this, if we didn't have to ask for anything, we wouldn't. We would give you the loan if we could, but we have to. That's FHA's requirement, so we have to do it. So I'm sorry if it feels like that you're turning in a bunch of junk. It's what it is, unfortunately. But that's how you get the money, so you have to do it.
Well,
As far as
giving you more money, and so they need to verify more stringently because you're not putting down as much. So yeah.
right. Well, remember the 2008 mortgage meltdown? Everything that we have today really came out of that. I've done this since 2003, so I can tell you from my experience in those cowboy days, anybody could get a loan, and you saw what happened. Like there was a major meltdown. So we don't ever want to have that problem again. And so there needs to be some oversight. There needs to be some accountability in how we lend money to protect not only the investors that are funding the money, but also the buyer too. I mean, they've got some skin in the game too. If your house goes into foreclosure, your credit's ruined for a long time. So now we have to determine your ability to repay. That goes into the proof of income part. If we approve you, I don't know if y'all know this or not, but if we approve someone for a loan and they close and they default within the first 6 months of the mortgage, they could the secondary market could really question whether we really determined their ability to repay that mortgage or not. We could get fined. I could get fined. So we have to make sure that we're doing all the due diligence to make sure we're not just protecting ourselves, also the client and the secondary market. Everybody involved in this has to be protected. So that's why things are the way they are now, because of what happened in 07, 08. Big hickey on the industry. Back then I was like, people like, what do you do? I'm like, mortgage. So I didn't want to tell anybody what I did. I was like, how long is this going to take to get away from this? So took a while. As far as residency goes, FHA, you have to be here legally. That's the big thing with on who's able to buy a home with FHA. You can be a non-permanent resident. or permanent resident. But if you're here on asylum or some other specialty reasons, what I'll tell you if you're listening to this, we're going to ask you for your employment documentation and your residency documents. And if I'm not sure if you qualify or not, we can get you through our underwriting department to make sure that you're good to go if you're not a citizen. You do not have to be a citizen to buy a home in the United States, and you don't have to be a citizen to get an FHA loan. But if I'm not sure based on the documentation that you provide as the bar, then what we do in that case to protect you so that you're not wasting money is send it to our underwriting department where they can make sure that you're good to go before you ever get out there and start finding a house and spending money. Occupancy on FHA loans, it has to be a primary residence. It cannot be a secondary home or investment property. And believe it or not, that's been a huge point of fraud in the last 20 years, or really not 20. It was a problem before the 2008 meltdown, but after the meltdown, when things got really tightened up, people started committing occupancy fraud for better terms. So they're going to make sure that you're going to be living in the home as your primary residence, and you'll actually sign an affidavit that says that you intend to live in the home for at least 1 year after closing. They know that life changes. They're not going to jail you to that house for the next 30 years, but the intent has to be that you're going to live in that home for at least 1 year after closing.
Well, and now in Oklahoma, you must be a U.S. citizen to purchase land or property in Oklahoma. That's a new Oklahoma law. So you do have to be a U.S. citizen for Oklahoma now.
So that's weird. Like we've had some buyers closing that are ITIN. There's some weird underwriting misunderstandings there between what the state wants and what the loan programs will allow. So it's interesting to see how that's going to fall out, because I know that rule, but we've closed some that are non-permanent and permanent residents. So it's weird. I'm curious how that's gonna fall out. You may see a situation where they get closed and we're forced to pull them back. Not that the buyer it wouldn't affect the buyer at all. It would affect us. We would have to buy the loan back from the secondary market and maybe take care of it internally. So I don't know. That's going to be interesting to see how that works. That was a law that came out this year, right? That Stitt signed in
Last year.
last year.
23. Yeah.
Yeah,
It was
it was
November
last year.
November of last year. November 1st.
November of last year.
Yeah.
It's
November
really
1st.
strange. It's not being enforced. I can tell you that much.
Well, contracts even. It says it talks about non-foreign in our
Non-foreign citizens.
non-citizens.
Huh.
Yeah.
That's strange. Okay.
Well,
Interesting.
sure that we address that either way.
Right.
We're on
Yeah,
top
we'll
of
get it figured out. We just all that to say is we'll make sure that you're not wasting your time or money.
True.
Same thing with this as a conventional loan. The same three buckets exist: down payment bucket, closing cost bucket, and your prepaids and escrows bucket makes up your total settlement. I won't dig back into that again. Please look, the guidelines can vary. On guidelines for FHA loans and really any of these loan programs we're talking about today, remember we talked about how institutions can decide how they want to originate these loans. Just because FHA allows something doesn't mean, or conventional or any of the other ones we talked about, doesn't mean that the originating lender will want to do it that way. They can always, again, tighten it up. So, and I'll use a very close example. Some institutions don't want to write FHA loans less than 620. Some not less than 580. Some will go all the way down to 500. It just depends on the institution. Did it work?
One more time. There you go.
There we go. 184 loans. I love this loan. I think it's a great deal for Native Americans. I've used this loan personally in the past, and it's gotten so much easier to do. When I bought my first house, I tried to use this loan, and back then, if you had a $20 medical collection that had happened in the last 12 months, you couldn't do the loan. That doesn't exist anymore. Now the rule is on collections, just touch on this part of it, is you can't have any active collections as of the date of the application. And the date of application is not the date that you pre-qualify so much with me. It's the date that we get a contract and make it a real deal. So you just have to, if you qualify with me and I see a collection, you're going to have that paid prior to going into contract. The letter from that particular collection company has to be predated to the contract date. Just housekeeping item on that. But to go back to how much simpler it's gotten, used to way back in the day, you had to go through the government office to get this loan, and it would take forever to get it from start to finish. Now you can be endorsed as a lender to do this loan. And if you're endorsed to do a Section 184, in other words, endorsed to underwrite and fund that loan and close it, then we can close it within, any standard contract period, 20 to 30 days. If you're not endorsed and you have to go through DC or the Denver office, you need to probably write that contract for, I would say, 75 days, no less than 60. So there's a key point here, to make a note. If you're Native American, if your lender that you're talking to is not directly endorsed, you are at a massive disadvantage when it comes to buying a home with competition. If your competitor that's trying to buy the same house as you and doing the same loan as what we'll say Bank of Oklahoma Mortgage, for example, because we are directly endorsed, and your lender is not, and you're asking for 75 days and or 60 days and they're asking for 30, you're probably not going to win that contract. So just a tip on this, make sure that your lender is directly endorsed. And when you're getting qualified, before you even fill out the application, if you're not talking to me, ask them if they're directly endorsed to do this loan. That is very, very important. Okay, but this is a type of FHA loan, by the way. The FHA loan we just talked about, technical term for that is a 203B loan. Technical term for this loan is Section 184, but this is still an FHA loan. Let me get to the next slide there. I'm getting good at this, Sarah. Okay, so you have to be part of a federally recognized tribe. You can Google, Native American guidelines, and I think Dana has a pamphlet that has that on there, right?
They don't have to, because if they go to our Facebook group, we have all of the tribes listed, and there's also links on that document to their tribe's grant benefits if their tribe has them. So if they'll just go to our Facebook group that we mentioned at the beginning of this presentation, they'll find all that information. We got lots of Native American stuff in there.
That's great. That's really helpful because as a new home buyer, this Native American loan can kind of seem daunting. One of the things I hear a lot about this is that they think their tribe offers this loan. Guys, the tribe does not offer this loan. They're just going to point you in the direction of a lender that does it. Some of the tribes have preferred lenders. I would I don't want to say steer away from that, but there's a lot of great lenders that are local that will do that loan for you. That a lot of the ones that they utilize aren't necessarily local. And when we talk about buyer competition, when you're making an offer, you want to have a letter that is well known, liked, and trusted, I guess is a good way to say that, so that you're not competing at a disadvantage. So I'll say about that part of it. But we do offer that loan, and we are directly endorsed to underwrite and fund it here in-house. And our underwriters are actually here too, so that's good. What else do you have on here? Oklahoma is a unique state in that it's wide open. And Bank of Oklahoma will lend in any state in the lower 48, with the exception of like New York City and a couple other places. But for the most part, we lend everywhere. And when you look at some of the other states that offer this program, it's a nightmare. It's from county to county and on whether it's available or not. And sometimes from tribal reservation to tribal reservation, it's highly geographical. And in Oklahoma, we're wide open. No matter where you're at, you can do this loan. You do not have to be in your tribal native reservation to do this loan. You can be anywhere. So that's a huge plus. There is no credit score to this loan. That's the good part. The bad part to that is that there's no automated loan approval, meaning we can't push this application into our automated underwriting system and get a yes or a no. We have to manually review this from a nuts and bolts perspective to make sure that you qualify. So you better find a loan officer that knows what they're doing. Again, I've done this loan, if I want to up talk me slightly, I've done this loan for a very, very long time, and I'm Native American, so I can navigate you through this very securely. That's all I'll say about that. But they better know what they're doing on this loan, because what I see happen more often than not is someone will get qualified in a contract on this loan type and end up having to pivot to FHA because their debt ratio goes over the limit. And we'll get into that, I think, in another couple slides on what the debt ratio limits are, but they're lesser than standard FHA loan. Come on. Maybe now. There we go. It's 2 clicks, I think. I got to click it twice. Okay, so the down payment on this, guys, is 2.25%. Remember, FHA is 3.5. So if you're borrowing, if you're doing $100,000 sales price, that's $3,500 versus $2,250, right? So it's a little bit less out of your pocket, which if you're a first-time home buyer, every stinking dollar counts. Take advantage if you can. The debt ratio limits on this, it's 41% on the housing ratio. Remember we talked about, I'm sorry, the total debt ratio. Remember we talked about ratios. The housing ratio is 29, meaning you divide the estimated housing payment by your gross income. That's how you get 29% or less. And then for 41, remember it's all of your payments on your credit report plus your estimated housing payment divided by your gross income gives you your debt ratio, your total debt ratio. We need to be below 41% on that. That's again why it's very important, going back to income calculation, that we do that properly. Now, they will allow you to go up to 43%, but we have to have some very clearly defined compensating factors that will allow you to do that. And those are some of those things are like, I'll use one example, payment reserves. If you have so many months of mortgage payments saved up in like maybe a 401k or somewhere else, that's a compensating factor that will allow you to get over the 41%. But if we need to go over 41, we can look at that, but we have to stay below 43 no matter what. If we get into that range, another thing I might throw out there is that I'll probably have you get a homeowner's insurance quote so I can make sure we know exactly how much your payment actually is, so we know where your debt ratio actually is, so that we can protect you from any of those mid-process bumps that can happen. And I'll give you an example. If we estimate your insurance at $1,600 a year and it comes back to be $2,500 and we're at 39.99% on your debt ratio, guess what just happened? Your budget just got busted mid-process. And so we want to make sure that we're at least preparing for that as much as we can. So if myself or whatever lender you're working with asks you to get a homeowner's insurance quote before you even have the house under contract, that is why they're trying to protect you from that mid-process pitfall that can happen. And it's very frustrating when that does for everybody. So nobody wants that to happen. Loan limits on FHA or on the 184 loan, you would think they would follow FHA, but they don't. They kind of march to their own drum. They will increase their loan limits, but their fiscal year ends for this kind of thing in May. At the end of May is when, so probably in June, we'll see what their loan limit goes up to. But 417 for the most part covers pretty much everybody that I've ever had to do this loan for that needed this down payment percentage. Generally speaking, if you're up to that price level, you're in a conventional loan anyways. So not a big deal. On the mortgage insurance, actually that's out of date now. So this year, I don't know why I didn't catch that, but this year they dropped, they lowered it. I'm sorry, it was 1.5%. So they lowered the upfront mortgage insurance premium from 1.5% to 1%. So that's good. It got cheaper. That can also be financed into your loan. And then there was a monthly mortgage insurance premium, and they dropped that this year too. So this program is awesome in the fact that there's no mortgage insurance, which if you're comparing it to FHA, you just saved $55 per $100,000 financed. That's great, you know. Property requirements. This is going to follow very closely to FHA's requirements. It's almost no different. Now, if you're getting assistance from your tribe, this is my caveat to that statement. Your tribe may have specific property requirements if you're getting their money. And so we have to take that into consideration too. So if your closing is contingent on their funds, we got to follow what they want to do too. So, Dana, do you have anything to interject on that?
Well, I think Cherokee is the most stringent. You do have to buy within the reservation. However, there is reservation all around Tulsa and parts of Tulsa, all the way to Tahlequah. I mean, their reservation is the largest reservation in the state. The other, and I think the Osage they actually, the nice thing about the Osage is they just give you a flat amount, $5,000, which is awesome. The Choctaws, I'm not sure what they do. The Creeks also give you a blanket amount of money. I think it's also 5,000, but you can use that wherever. It's very similar to the loan in that you can use it in any county. They don't care. So it'll just truly depend on your tribe. But again, we do have that PDF in our files that will take you directly to the link to your tribe so that you can research that. So we've taken the guesswork out of it, and we can direct you directly to your tribe, to that department and to those applications online. It's really helpful.
And just to reiterate, that's not for the loan approval. That's for assistance if you're trying to get it through the state.
That's for grant money. That's free
Right.
money that the tribes offer to the members of their tribe. And you do have to be now, I'll tell you, I think it is the Choctaws actually, like they'll give grant money to any Native American, but they have a preference to Choctaws. So I would go through and look at the entire list to see if maybe a tribe is more friendly than another, because you never know until you ask. That's the thing.
Right.
Always ask.
And I'll touch base on that the Cherokee. It's the MAP program, mortgage assistance program. I want to say they take about 6 months. They give you quite a bit of money. I think it's like 20 grand,
Yep.
but they have a program that you have to go through to get that money, and it can take up to 6 months. So if you're
You
really
have,
depending on that money, do it quick,
yeah,
get started.
yeah, you have to meet with a counselor. They assign you to a specific counselor. You do have to go through their course. It's for an entire week, Monday through Friday, all day long. Actually audited that course year before last just to understand what's required, and it's an excellent course. They just want to make sure that you're ready financially, mentally, that you got all your ducks in a row, and they want to make sure that you understand not just the purchase part of it, but how to maintain your house after you own it so that it's a blessing to you and not a curse. So yeah, but the nice thing about the Cherokees is that you do get assigned to a specific person, and they're going to walk you through that really well. But you're right, it does take time to meet all the criteria that they want you to meet in order to get, because it's a lot of money. $20,000 is a lot of money.
Yeah,
Just a
I'm gonna use
handover.
that when I was buying my first house.
Yeah.
Okay, so we talked about some of these other things on the geographic restrictions. There's not any. Appraisal against pretty much the same. And then it does have to be your primary residence. It cannot be a second home or investment property. Ah, no. Can you put me back one, Sarah? Oh. We already did that one.
Now, before you get into the USDA loans, I don't know about you, Sarah, but we're still not seeing these, honestly.
I don't think you did that one.
Somehow we got into USA. Sorry, guys, if you're online watching, technical difficulty.
Right here. You're right here because you were here.
Okay.
And now you're here.
Now I'm there. Okay, I'm gonna let you do it, Sarah. I don't know what I'm
Okay.
doing wrong.
I'll do it. That's
I
fine.
think there's a delay on mine and not on yours.
Maybe. Maybe.
Standard eligibility. Again, I don't want to debate the citizenship versus non, but
Right.
if as long as you're an eligible buyer from a residency standard, you're good. Same thing with closing costs. We've already talked about that. On the amount that the seller can contribute is up to 6% of the agreed sales price. So that's $6,000 per 100,000 in sales price. FHA is 6% as well. Conventional loans is tiered based on your down payment, but for the purposes of this call or presentation, it's 3% if you're just doing the minimum down payment. Okay. And then I think that's there are refinances available for the 184 loan. Those include cash out refinances. If say you bought the house and in 5 years from now you want to look at maybe dropping your rate and taking some cash back, you can do that. Or you can just do what's called a standard rate term refinance, where we're just refinancing the balance for a lower rate.
And it doesn't have to be a spouse. You can also have a co-borrower that's not native as well. Just one person on must.
Correct. So if you are applying for this loan, make sure the person who is the tribal member is applying as borrower position 1. Don't be in the co-borrower position. Okay, RD loans. These loans are great. These loans kind of borrow. If you had a conventional loan circle and you had an FHA loan circle and you blended those into that football in the center, if you overlap two circles, that football that it creates, that's USDA. It borrows from conventional lending and it borrows from government lending, and it's its own nice little wonderful loan. There's two different types of rural development loans. Just for the purpose of this call, we're talking about guaranteed. There is a USDA direct loan, but that has to be done directly by the USDA office. You deal with them. If you get a USDA loan from a loan officer at a bank or a mortgage company, it's going to be the guaranteed loan. Okay. The guaranteed loan has looser requirements than the direct loan. So you want to try to do guaranteed unless there's a very specific reason why you need direct. And the one that comes to mind specifically is if you're wanting to buy a double wide brand new off the lot and need a construction loan from the rural development department, you will need to go direct because you can't do that with a guaranteed loan. Okay. But you can do construction loans, just not double wides that are coming brand new off the lot. That has to be handled by direct. Okay, good. Requirements. Now, there is a website that we may need to put in the comments somewhere that you can go to for eligibility. You plug in the address and it'll tell you if it's eligible in an eligible area or not. And there's also an income tool on there too that you can use to see if your household is over or below the income limit for the program. Same thing with residency. We won't get into that again. This has to be your primary residence. And then the minimum credit score for USDA is 640. So let's run a quick scenario. Let's say you're at 635 and you've got to have this loan. We have a tool that I can use to see what it takes to move your credit score up in real time. And I'll give you that information. You'll go do that. And once that time has passed, we'll update your credit report and we'll be ready to go. So even if you're not quite to 640, I'm not just going to tell you no. I'm going to tell you, hey, not yet, but here's what we got to do to get there. You will have a roadmap, a very clear one with exact timelines on what it takes to get there. You'll be overly informed, I promise. Next one, Sarah. Down payment, again, there's no down payment. That's great. So if we go back to that one total settlement, down payment plus closing costs plus prepaids and escrows, we got rid of one thing. Now we just have to worry about closing costs and prepaids and escrows. So that makes your out-of-pocket goes way down. Now, this one does follow the rule or the 184 loan as far as debt ratios go. It's 29 and 41. Same thing with the other program. If you're going to go above 41 but stay below 43, there has to be some compensating factors that they've defined as compensating factors that you have to get there. So if we're going over that 41, I'll have to look and see if you have those compensating factors, at least a couple of them. And then loan limits will follow conventional loan limits. However, most borrowers in that price range, if they're pushing the very loan limit of the rural development loan, they probably make too much money for the program anyways. So this really has never been a problem if people wanting to get this loan and being too high on their not being able to get it because of that anyways. So the loan limit probably isn't a big deal. Mortgage insurance, they have a monthly. They have a monthly and they have what they call a funding fee. That's 1%, and that's financed into your loan. So when you do this loan, your loan is 101%. So you want to make sure that if you're going to do this loan, that you're going to stay in it for a while, because if something happened, you had to sell pretty quickly, you're going to be upside down. So this loan sometimes is as great as it is not have a down payment. You are financing a little more than what the value of the property is at the time of the purchase. Now they do have really cheap it's called a guarantee, a yearly guarantee fee that they break up, but it's basically mortgage insurance. And it's 0.35. Remember we said FHA is 0.55, so it's a little cheaper than FHA. So $35 per 100,000 financed. Property requirements, it's pretty much the same as conventional loans. Where it starts to get different is when it comes to manufactured housing. If we're talking about double wides, there's a lot of extra rules that surround those with the RD loans. So if you're looking at buying a double wide that's existing, it has to meet HUD guidelines, number one. That's where it borrows from FHA, but it also has to as far as like the well water and the lateral lines for septic. There's a lot of things that go into that too. So that one's a little more difficult of a loan to navigate. So if you can avoid that loan for your first time, you might want to try that. But if not, we can work through it with you. There's just a little extra involved. Occupants requirements, yes, it has to be your primary residence. It cannot be investment or second home. And it's the same thing on the intention. You'll sign an affidavit that you're going to plan to live there for at least 1 year after closing. Settlement and closing, same thing we talked about earlier. I won't dig into that too far. 6% is what you can get from the seller on this loan. So again, $6,000 per 100,000 in sales price. And then what's the rest of this? Oh, on the refinances, yes, we'll do a rate term refinance, and they can do cash out refinances. Property types, they're all about the same. You can do single family homes. We can do, I think it's 1 to 4 units in eligible areas. And I have to double check the 1 to 4, but I'm pretty much sure we can get 1 to 4 on that. That's what it borrows from the conventional loans. And then as far as the property requirements, it's going to follow closely to FHA. And again, on geographical considerations, if you'll go to that website and if you'll just Google USDA RD eligibility, it'll bring that up for you to check and see if the property that you're looking at is qualified. Or you can just call me or email me or text me, or your loan officer that you're using. They can look it up in seconds for you to see if it's actually going to work. VA loan. This is another great loan for individuals that are veterans. There's no down payment. Now, the one thing about this loan that some people don't know is that the appraisal process is controlled by the VA, and we'll jump into that here in a minute. But I just wanted to preface this that sometimes people want their appraisals back really fast, and we have zero control on how fast those come back to us. Eligibility, we'll order your certificate of eligibility. We get that online now. It used to, we have to get your DD 214. In some cases we have to. So there's an automated service now where we'll plug in some of your information. It'll send us your certificate of eligibility immediately. It lets us know if you can or can't do a VA loan. If it get returned because they can't do it automated, then we'll get your DD 214 and do it the old-fashioned way. Now, if you're a National Guard, it is 6 years of service before you're eligible. But on the National Guard and reserves, if you went into active duty in a wartime zone, then that will supersede that 6-year requirement. You'll be immediately available. So that can help you if you're in the National Guard or reserves, get immediately available going into a wartime zone. Check with the VA on that, on which zones that would be, but you can get out of the 6 years if you serve in a high risk zone. Other than that, 90 days of service if you're a regular military. Spouses, on that part of it, they're the only eligible co-borrower. You can't have a non-spouse like a mom or dad co-sign with you. It has to be a spouse of the veteran. And then dishonorable discharge, you're not gonna you're generally ineligible. So you'll have to have honorable discharge. Credit scores, it's generally speaking 600 or higher. I've heard some institutions doing lower, but from what I understand, it's 600 minimum or higher. And the flexibility here is that there is no down payment, which really helps a lot of VA buyers, and there's no mortgage insurance either, which also helps affordability. The debt to income ratio, this is the one that really, it was surprising to me that I've had veterans get approved for up to 70% debt to income ratio. I thought that was wild, and I almost wasn't sure I should give them the letter because I was so worried that if they breathed wrong on their file that it would be not approved. But we send the VA applications through the automated underwriting system, and it'll determine how high based on their overall risk profile that they'll allow the debt ratio to go. So that's been a newer thing within the last 3 years. They've really opened it up to try to get more veterans into home ownership. So that's a good thing for the veterans. Loan limits, it just depends. There's some differences on loan limits, but standard is 806. From what I understand now, is that there's a possibility of going up to $1 million without having a down payment. But we'll have to, those are case by case. That's why I didn't add that on here yesterday, Sarah. So if you want to do a VA loan and you're wanting to do $1 million financing, call me so I can double check to make sure you're eligible to finance 100% of that. You may not be able to do 100%. Maybe you got to do a small down payment, but eligibility above 806 is there potentially. You can click the next one. And then, again, we talked about this earlier. There's no mortgage insurance. There is a funding fee, and it depends on your scenario. But if you're a first-time user with or less than 5%, you can see this table. I won't go through the table. The main thing to know, though, is that if you're disabled from service of 10% or more, you don't have to pay the funding fee. And then if you've got 100% military related disability in Tulsa County, you don't have taxes, which you'll have to get that pulled off your loan post closing, because you can't apply for that until after you've closed. So we still have to collect for taxes in the escrow, but after closing, you'll just give them your proof of purchase to the county, and then they'll do your eligibility for that. That's pretty much it on that. As far as appraisal goes, there used to be these things called VC codes back in the day, and it made doing VA loans a nightmare. This is 15, 20 years ago, but now from the buyer's perspective and from a realtor's perspective, it's really not much different than an FHA loan. All the government loans are about the same on property requirements. And I'll touch another thing on this. Like sometimes agents in the market, if they're looking at a VA a letter versus a conventional or FHA letter, they tend to sometimes move towards a non-VA client. But I'll say for the purposes of this that the appraisal process is almost the same. So there's really no reason to differentiate between any of those different loan types from a seller's perspective.
I agree. I'll even do with a VA loan, actually, if the appraisal comes back low, I actually have more of a chance to fight it than if I do an FHA loan. So, and
that's the Tidewater process.
Yeah. Yeah. So the appraiser has to reach out to me and send me, I get to send in listings that will match it to see if we can't get it up higher, which with an FHA, I don't get that. And it's a lot harder to fight an FHA than it is a VA.
Yeah, I mean, if I added up all the appraisals for FHA and conventional over the last 22 years that we fought, I can only think of a handful that had more than a $1,000 to $2,000 bump in value. So way different with the VA though. Occupancy requirement. This kind of goes along with all the loans that you're calling a primary residence. Any of them, it's 60 to 90 days, depending on the loan program. In this case, VA is 60 days. They want you living in the home. So if you're overseas in this case and you're not gonna be able to move into the house for 6 months, then you won't qualify to do a VA loan yet. Now, if you have a spouse at home that can move into it, that's a different story. On this total settlement, kind of talked about a minute ago, there's no down payment. So you just have to worry about your closing costs and escrows, which we can work with you on that. There is assistance that we can utilize to cover that part of it. Since there's no down payment, that assistance would go towards that instead of the down payment. And then the seller in this case can do up to 4% of the agreed sales price in concession. So scenario would be like we get down payment or we get assistance from the state to cover the 3.5% assistance. If that's not enough to cover what's due at closing, we can lean on the seller to cover the small difference, or maybe the family can help them. Refinance options. We call it an EARL loan for short, but it's a streamlined VA refinance. Those are fun, easy to do. If you're a current VA homeowner and interested in refinancing when rates come down, I can help you out with that. Those loans are super quick and easy. And they also do offer cash out too, same as all the other loan programs. That's going to be based on 100%. With like conventional loans on the cash out, it's 80% max. of the value of the home. And with FHA, it's 85% of the value of the home at the time of the appraisal for those cash out refinances. Yeah. The incentives on the lender incentives, I want to talk about that. So
Yeah.
most lending institutions have some sort of VA incentive. At BOK, I want to say we offer, I think it's, don't quote me on this, but I want to say it's like $500 off closing costs for our veterans. And then once you're actually a BOK mortgage customer, after that, anytime that you buy or refinance, you qualify for loyalty rewards, which is, I want to say $2,000 on purchases, and or maybe it's 22. There's a couple $1,000, I'm not sure exact number, on purchases if you're rebuying, and then on refinances, it's, I think it's half of whatever that is. So there's a lot of incentives we can offer too for veterans, and then repurchases and refinances. Especially
So let
whenever
me,
rates come down, we'll have incentives for people that bought with us
yeah.
prior.
So I had a client who was VA and he was purchasing property, and I was just doing the paperwork. Like I had this, I knew the seller and they were family, and it was, anyways, they were buying it. And I tried to get this veteran to, he was using a big box mortgage company. And I try to get him to use a local lender. And I'm like, I promise you it's going to be smoother. You're going to like it a lot better if you go local versus big box. And he was just at me. He's like, no, I've been with this guy for forever. He's helped me get my credit up or whatever. I'm just going to stick with him. I'm like, okay, that's fine. And so, but at the closing table, he told me, he goes, because there was a lot of hiccups, a lot of
Mm-hmm.
hiccups. And, and it was all on the lending side. And I was like, he goes, I almost threw in the towel. He goes, I wish I would have listened to you, and the big boxes usually don't do any kind of incentives for the veteran, and yet they're veteran named and they don't do anything for the veterans. So I would just shop local. And because I'm telling you, your local people are doing more for the veterans than the big box companies are. So, and I
Well,
mean, I have a whole family of veterans. So my dad is my father-in-law, my uncle, my grandpa. It's like I'm a, military people through and through. But they do not always do what's best for you. So,
well, I won't name names, get myself in trouble, but there is a mortgage company online that is very well marketed as though
yeah.
they appear to be the government. And a lot of times the borrower thinks it's actually the government doing the VA loan, and it's not. They're just so branded that it looks that way. And I'll give a very specific example. I had an older gentleman. He was probably in his late 60s or early 70s, trying to buy a house a few years ago. And he was like, hey, I'm going to go with them. They're offering me a better deal. I was like, what do you mean by better deal? He's like, oh, they got me a better rate. I'm like, well, can you send me what they sent you? I'm just curious for my own, competitive purposes. I want to kind of know
Yeah.
where we're at, and yes, the rate was better than what I had offered him, but they were charging him like $7,000 in points for that rate. And I said, hey man, did you know they're charging you this much money for that rate? He's like, no, they told me it was a government fee. I'm like, no, I can give you that same rate for almost no cost. So he went from $7,000 or whatever it was. I think our cost on that rate was less than $1,000. He couldn't believe it.
Wow.
And when he called the guy on it, the guy just waffled. And the thing about it is, and it doesn't matter if you're doing a VA loan or whatever, when you're dealing with
Right.
someone who's online or out of market, it's just a different feel because they're not accountable. Whenever a real estate agent, especially a real estate agent, refers a client to us, we're not just accountable to that client, we're accountable to that agent. So we want to make sure that everybody involved has a very good experience. And that accountability you're never going to have online. And the one thing that I think that most people don't understand is that all of us are almost the same when it comes to like what the lender's actually charging on their origination, not to get into points and all that junk, but just on what the origination is and their rates. So if the guy next door, gal next door is offering a slightly better deal, we're all going to be willing to match each other. So it just kind of comes down to who like, and trust, and maybe who you click with better from a personality perspective. But again, I'll go back to what we talked about in the very beginning. Buyers only know to really beat down on what the interest rate is. But if you look at what the payment difference is between 7, or we'll say 6.5 versus 6.375, some buyers think that's a gigantic difference, but what it is in payments, almost nothing. And it becomes such a huge ordeal that they'll give up a much better experience over a small difference that we probably could have matched anyways. And you know, when you get a year away from closing, do you think that buyer remembers if the rate was 6.25 versus 6.375 or even 6.5? No, but they do remember how either terrible that transaction was or how great it went. So,
Yeah.
you know,
Well,
it's
and
not
I
always.
tell, oh, sorry.
I was just saying it's not always cheaper is better, but just if you're watching this out there and most buyers are like, I'm gonna shop, go for it. But understand that most of us are gonna be willing to match each other. So you don't need to shop 20 places. My advice would be pick 3 local places, check them out. And if you're just have to see what the online adventure is going to be, maybe check one online person. And then I guarantee your local person is going to be willing to try to get it as close as possible to your online person if it's way off. If it's not way off, they're going to match it. You know, you're just not going to lose ground to stay local. And I'm going to take it back that one of the piece when you're in a first-time home buyer market and it's more of a seller's market and there's multiple offers, if you've got nobody knows who you are.com mortgage letter versus we know who you are local mortgage letter, guess who doesn't have a chance any longer? You don't. So don't do that to yourself. Don't do that to yourself. That's my only
well,
big
you know,
piece.
and I tell my clients too, I'm like, you know, the nice thing about using somebody local is I can pick up the phone and I can call Brian on a Saturday night or a Sunday night or, you know, Christmas Eve and be like, hey, not that I would call you on Christmas Eve, but
I'll
you
take your
know,
call.
if there's an issue or something that pops up, I can call you and you're going to answer your
Right.
phone and you're going to answer the question that we have, you know, opposed to a big box company. You're just a file on a desk. I can't get a hold of somebody, the buyer can't get a hold of anybody, and it's just frustrating for everybody. So
It's like a lot of them will do like, okay, this is the introductory call person. Now it's this person. Now it's this person. So you really just never kind of know where you're going to end up. And they definitely so disconnected from the local market. They're not going to, you know, more than likely they're probably not going to call. And if anything's going wrong, you're definitely not going to hear from them. They're going to hide because they can, right? So anyways, the other soapbox ticket on that is when you do a loan with somebody out of the market, we'll just say out of state, that commission that's created for that closing for that loan officer is spent in the community they live in. So if you're buying in Tulsa, you want to build up the community you're living in. You want the money to stay here. So if people are doing well in this community and spending money in this community, guess what's going to happen to your property value? It's going to do well. So not that one transaction is going to turn the title to market, but it's just something to think about that money is going to stay here locally. So that's all I'll say about that. Gift money. If you're going to accept money, talk to us first. Don't accept money, cash, checks, whatever, and put it in your bank account without talking to us. We have to see your banking. We're going to see your banking. We're going to see your banking. So you can't hide it. I've had people that are first timers kind of get into a pickle about how they're going to make it all work and start just piling money in from all their friends and family, or even churches, for example, church family to make it work. And then we've just created a nightmare we may not be able to overcome because we have to document all the money available for closing. So now there are large deposit definitions and they're different for each loan program, but the buyers aren't going to know what those definitions are. And there's a thing called stacking too, that, you know, if they're stacking, you know, deposits to try to stay underneath the limit, like there's just so many little things that talk to us first before you do anything, because if we know what you're trying to do, we can tell you how to do it in a way that's going to allow you to not have any problems in your mortgage transaction. I'll give one example. I had a foreign couple a few years ago accept money from a family member that was from a country that they're not allowed to put money into U.S. currency. Like, it couldn't even be here, right? It was from one of those countries that they're on this whatever list it was. I don't know. It created a massive problem. So Not that that's the everyday thing. The everyday thing is like I went and sold a bunch of stuff and just put the money in my bank, and now I don't have a way to verify it. And I can't even give you credit for it being there. So before you do anything, talk to us first. But as far as gift money is going to go, yes, we can do it. You'll get a gift letter. The best way to do gift money is to have that money wired to closing the day before closing from the family that's going to give it to you, and we'll have them do a letter. And that's a pretty clean way of doing it, and it's easier on your paperwork. But bottom line, talk to us first on the gifting side of things.
Well, and the nice thing is all of these loans allow for gift money. All of them
They do.
And
They
if
do.
you have family that can help you, I would absolutely take advantage of it because it's a lot of money that you have to bring. It has to be a gift, though. There can't be any requirement of repayment, period.
Correct. And
Period.
it'll say that on
That's
it'll
a
say
big
that on the
deal.
letter.
Yeah, it's a
And
big deal.
if you're wondering what that means for the donor in taxes, I can't answer that question for you because I'm not a tax accountant and the laws change on that all the time. So have them talk to their accountant about that, what impact that is on their taxes. But from what I do understand, you can have a one-time gift to family. But talk to your accountant on that one. Now, as far as down payment assistance goes, there's two major ones that the state offers that we see most often, and that's OHFA or Oklahoma Housing Finance Authority, and then REI. There's a new one that just rolled out this past Friday, which is the Tulsa County Home Finance Authority, the first time program. I like this one a lot. We'll get into it first just because it's a true grant. But the problem with this program is there's only so much money. REI and OFA are continuously funded by US Bank through a nonprofit, so it never runs out of money, ever. Now, with OFA and REI, those REI has a program that's a grant. It's the interest rates are higher on that. They also have a second mortgage program that you can use for closing, and then they have one other option. They have so many programs at REI to pick from, and they even have a no assistance program. You just like the rate they offer. The one thing I'll mention on OFA and REI, which isn't listed here, is that because US Bank funds that money to the nonprofit, after closing, the mortgage will transfer to US Bank's FHA department for servicing, and they do control the interest rate on the primary mortgage. We don't get to. So if you're shopping for a mortgage and you're wanting assistance, might as well not shop because we're all going to have the same rate because we're going to go to OFA for that rate. Don't waste your time. Same thing with REI. If you're going to utilize REI, no matter which program it is, they're going to set the rate for that. Don't waste your time shopping around because every lender is going to have to go with whatever they say.
So
now, on the Tulsa account,
if you need money, tell your lender that right off the bat. Hey, I need some help.
Right.
You have any free money programs where I can get assistance, and then they'll be able to tell you what you qualify for, what would be your best fit, that kind of thing.
Right. So REI is a good program that's 5% assistance. So if you're doing FHA, that's 3.5% for your down payment, and you have 1.5% left over to go towards closing costs. So that allows you to ask of less of family or maybe less of the seller. That's a good one. I've used that a lot. But it's a second mortgage. So you're going to have two payments. You're going to have your primary mortgage payment and the second mortgage payment. If you do that second mortgage, it's 5% interest, which is low, over 120 months or 10 years. So the payment's not high or anything. You might be borrowing $7,500 on a 10-year term. So at 5%. So it's not a large payment added to your monthly payment, but it's still more money added to your monthly payment. They do have a 3% and a 2%, I think, assistance. That's a true grant. Those have different rates associated with them. They're going to be a little higher because they're grant program. That's a grant program. And then FHA is blended. It's 2.5% grant and 2.5% loan. Okay. If you go with REI, that's kind of a whole big broader bucket that I would just talk with the buyer about individually. I could do a whole hour presentation on REI in specifically, so I won't go into all the details, but it's available. And then there's OFA. That one's pretty simple. It's 3.5% of your loan amount. It is a zero interest loan, so you will never make a payment on it. But when you refinance the house or sell it, you will pay it back. If you never refinance or sell the house, maybe you won't pay it back. I don't know, but from what we're being told right now, if you refinance or sell the house, you got to pay it back. And then finally, we have the First Home program through Tulsa County that rolled out last Friday. That is a true grant. And I'm not for sure exactly how much it is. I want to say it's around 7,000. Sarah, you might know, you've taken the training.
Yeah.
I haven't. Is it 7,000?
It's 7.
Seven?
Yes.
Okay. There is a minimum credit score requirement for that program. I want to say it's 640. Is that correct, Sarah?
I don't remember what it is, but it will count anybody 18 or older that lives in the home. All of their income counts
Okay.
towards the total
So,
income of the home. So
they're going to go with household income for
yeah,
eligibility.
Yeah.
So what that means is basically if me, my wife, and my 17-year-old daughter or son is working, all three of our incomes are going to be calculated for eligibility, even though not all three of them may be on, or all three of us may be on the loan app, right? Maybe we only have dad on loan app, but the First Home program is going to look at all three for the money eligibility. So there's two separate eligibilities that we're working through there that you just need to be aware of. But the one great thing about any of these programs is that we do them for you. You don't have to jump through a bunch of hoops to get them. I don't know all the details on Tulsa County just yet, but for Oklahoma Housing and Finance Authority and for REI, the bar we go over what the options. The bar selects the one they like with me, and I take care of the rest. It's super easy peasy for the buyer. They don't have to deal with a bunch of junk. Back in the day, I don't know if y'all remember, we had to have the old bond contract that had to be ink signed and dated by everybody. That was a nightmare. Those days are finally over, but this is very, very easy. And
Yeah.
on the First Home program, I don't know if there's education that the buyer might have to take. They may or may not have to. I'm not sure on that. But Bank of Oklahoma, our product team is actively working with that program manager to get this program onboarded. We are extremely close to being ready. So I would be surprised if we didn't have it before the end of the month, but definitely by the first of the year, we're going to have this program. The one thing to know about this program, though, is that because it's a true grant, there's only so much money. I want to say it's $25 million. And that's going to go probably pretty fast. I would say we'll probably have a good first quarter, maybe make it through the second quarter with that money, but I would be surprised if we got past the second quarter and that being available. So the one thing about this program that kind of beckons back to the old school bond days that I remember way back when is getting on a list and waiting for it to get reappropriated. That I don't know if that's how this is going to work, but there is only so much money. So get in while you can,
It's nice to have the backup of the REI or the Oklahoma Housing Finance Agency too. So if you can't get
Yeah, I mean, if we get
got options, there are options.
right. So yeah, you're right. If we can't do the Tulsa County, which would be the best option, we can defer, pivot. We'll find a way to make this work.
Well, and here's the other
Definitely.
part of it. Sarah and I and our team or any realtor that you work with should really be taking into consideration the longevity that you're going to need to stay in that property, your appreciation rate for that property, so that it is a blessing and that when you're ready to sell or move up, that we can take care of all the mortgages that are associated with that too. So you just got to be really careful with that. Make sure that the agent that you work with understands the criteria so that this is a blessing for you. We always want it to be a blessing, right? Always. Always.
Yeah.
And that's the main thing on this home ownership. I'll talk about when I bought my first home. The payment was $750 a month, and that literally terrified me. I wish I had that payment today. And I was, I feel like a lost puppy somewhat at first. I didn't get the greatest experience when I bought my first home, but I'm kind of glad I got that experience because now it helps me to help understand how to provide a decent and well-organized transaction for the first-time home buyer. So I do have that experience. I had a bad experience before when I first got into this business as a buyer myself. I'd not even been a loan officer for a week, I think, when I was trying to get into a house. So
you don't know what you don't know. I had a similar
Right.
experience. I didn't have a great realtor on my first purchase. I felt like she just wanted her commission and just didn't really educate us like I felt like we needed to at the time. So, you don't know what you don't know, but that's why it's important that you come to stuff like this, that you get the education that you need to make a qualified decision. Because that's really what it comes
Exactly.
down to, truly.
Right. And if you want, Dana, maybe we can talk offline later about doing some specific modules for OFA, REI, and Tulsa counties to get them out there. Because we
Yeah.
just did a high level talking about it today.
Yeah, yeah, absolutely.
All
Well,
right,
Brian,
so-
thank you for sharing with us, and
You're very welcome.
unfortunately, we have ran out of time. So in order to stick with our time limit that we've asked people for, we're just we'll put these extra slides. Most of it's just about budgeting, different free things that you can do to save money, to save for that down payment, to save for those closing costs. If we have time tomorrow, maybe we'll hit on them as well. But we just wanted, the loan part is just so important. We wanted to make sure you guys understood the different types of loans and that there are different types, and just kind of give you a good overview over what they can do for you. So don't forget to join our Facebook group, so that way you can get to all of the free guides that we have for you and all the free stuff that we have, so that way you guys can get those as well. So, but we'll be back here tomorrow, same time, and we will go over a lot more information as well. So if you have questions, please reach out to us in the group, and we'd be more than happy to answer them for you.
Thanks again, Brian.
So does
You're
anybody
welcome.
else have
Bye-bye.
anything else?
Nope.
No? All right. Well, thanks so much. See you guys tomorrow.